Hello, and thank you so much for kind of tuning in to a quick market update from Carriage House Planning. Um, Today is September 24th, 2020. We are in the midst of a really beginning to heat up an election cycle in the United States, but the whole year has obviously been one for the record. Full disclosure, whatever it might be, none of this is me trying to read the future. I can't read the future. What I can do is I can look at the weight of the evidence of the current state of affairs. I can look at the current data and details, and I can draw conclusions of probability. That's ultimately what good investors do, is we look at the weight of the evidence of probabilities, and we play favors to those events that have the highest probability of occurring, while we underweight the events or the circumstances that have the lowest probability of occurring. So, in general, let's look at the stock market in general. Wacky year, we know that. We ended up having a massive sell-off because of a fairly unprecedented move by a Democratic government, and that's not just one Democratic government in the United States, but virtually every Democratic government across the entire Western world seemed to have radically adopted what is otherwise simply a communistic approach to dealing with so-called pandemic. The political approach to dealing with it in shutting so much down and mandating that businesses be ultimately the bearer of the punches that were being thrown by the government into the private sector. That's very unfortunate, but that was reflected in the market. However, the resiliency of the small business or small to medium-sized business may also be reflected in the rapid recovery and ascent, but really what we can attribute the market's quote-unquote recovery in 2022 was the interference and influence of the Federal Reserve and the Federal Reserve policies. These incredible easing policies that have been really a part of our daily lives for the past 10, 11 years now, following the 2008 and 9 Great Recession. Won't get into all the details on the history there. We'll do that another day. But what I do think is worth noting is that the overall strength of the market is almost directly attributable to the Fed's influence. And one of the best ways that you can see that, or one of the best ways that you can witness the empirical evidence supporting that claim, is that, generally speaking, large cap companies rebounded not only quickest, but with the most, let's say, momentum or force. And yes, you can say that in general, large cap companies can weather storms better. I think one of the things that's missing in this conversation is that large cap companies should not move as quick, as rapid as small cap companies, or those that are more nimble, more easily influenced by various market risks. Yet they did move fast. And really what they moved fast on was the concept or the belief that Federal Reserve's policies, the Fed easy money policy, the lending policies, reducing rates to effectively zero, printing money at a pace that really should concern everyone, issuing debt and buying corporate debt. That's a big key to this, buying corporate debt. The Federal Reserve, the Treasury, buying corporate debt. Those influenced large cap companies at a much greater rate than they do the other parts of the marketplace. And also, when it comes to borrowing, a lot of these incredibly large cap, what we would call mega cap, these blue chip companies that, by no coincidence, based on our economy and the world marketplace being so tech driven, so tech heavy, the big names tend to be those that are tech oriented. You have the Facebooks, you have the Apples, you have the Googles, the Alphabet, Netflix. These big companies, Microsoft's another one, Oracle, you can throw all those in the mix. They all tend to be tech companies. They all tended to be market leaders. They were the ones that really pulled the market up and out of the slump, while the rest of the companies did take a lot of time to recover. But the other thing that they have is they are generally highly capitalized companies. They have a lot of cash. Yet, by virtue of being as large as they are, they can issue debt at a 0% rate. In other words, they can borrow for free. And not only will the marketplace buy it up, But now we also have the Fed that has a policy that will effectively buy up that free debt, in their case. So these companies are companies that had a ton of cash. They could have spent their cash, yet they didn't have to. They had free money available to them. We know that is what really drove the recovery. We moved into June, July. That's when we started to see the first, let's say, retest, or the first kind of question of, was this rally really sustainable? As it retested there in kind of the early June period of time, it was a pretty rapid sell-off, but generally in that case, what we saw was a pretty quick turnaround for most companies. But that's also when we started to see more market breadth, meaning it wasn't just the large companies anymore that were ascending. That's when all of a sudden the smaller, the mid-cap companies really started to surface. And generally in their case, the reason for them kind of picking up steam was that those initial impacts of the easy money policy and the Fed's interference into what would have otherwise been open markets, it trickled through to the small businesses, but it took time for these small businesses to gain access to monies. They couldn't just go overnight and just quickly borrow, as the large companies do. They weren't capitalized either, so they couldn't live on their own cash for any period of time before accessing these, let's use big fat air quotes when I say it, but free money. Then we got to where we are now. Okay, let's fast forward again from July into August and then September. We started to see the first major sell-off, or the first major even questioning of these big tech names, really. That's why we saw the NASDAQ selling so aggressively. There's a number of reasons that we could point to at any given time, even though I've tried to create a summation for every market action so far this year. I'm brushing the surface. I'm covering just a couple of major influences. But in this case, a number of things may have occurred there in the late August, early September timeframe. But really what we can look at in terms of our market corrections is something that it's almost too obvious, yet no one seems to want to talk about it. And that is, at the end of July, August, we're done with the political conventions. And now all of a sudden we are in what would be deemed the real election cycle, or the real election period. This is when the candidates are effectively chosen. Sadly, there's only two. That is the way that we have our state of affairs in the United States today. I strongly encourage anyone with a rational mind in America not to accept that, but instead demand that we have more options, that we don't just have to choose the, quote, lesser of two evils, but instead we actually demand that we have smarter policy makers running for office, and we have a wider diversity of potential options to choose from. But nevertheless, we have what we have, we got those, and now all of a sudden they're coming out, and they're going to come out swinging because they have to start to move the voting needle in their favor. You're getting Biden making his assertions on his major tax reform policy, a tax reform policy that by no coincidence he promises will not affect any household making less than $400,000. That's a very bold thing to say during an election period. Let's see if it holds true, because chances are there's no possible way that he could enact the type of reform on government spending that he wants to do. In other words, increasing government spending at the rate that he wants to by only taxing households that make more than $400,000. It will not foot the bill. So that would put us in a position where we borrow more. That hasn't been an issue yet. Oh, wait, no, yes, it absolutely has been a huge issue. It will continue to be a huge issue. And it's also a major reason why the Federal Reserve has another reason to keep rates low, because at the end of the day, the U.S. has to service all of the debt that they have acquired, the debt that they've borrowed, the borrowing of the future American, or rather the borrowing from the future American. It comes at a cost. There is still an interest payment that has to be made on that debt that's then used for all of this egregious government spending. But again, I digress. The key takeaway is that in this election cycle, the rhetoric does intensify. You get big promises. You get major platform pledges. That is a big influence on markets, not because the market necessarily cares which candidate wins. The market does not see red and blue. The market sees red and green. Please, please, please remember that. As an investor, you should not be focused on red and blue. As a person, have at it. Go for it. But as an investor, the overall political environment is not something that should be weighing on how you invest. Instead, what you have to do is look at the most probable cases where companies are going to succeed and the most probable cases of companies that will not succeed, and invest accordingly. But the increased and more aggressive rhetoric cast out by the candidates, what that does is it seeds in the marketplace a sense of uncertainty. Markets care about uncertainty. That's a big deal to them. If you have uncertainty as to whose policies will be predominant, whether it be bigger government or arguably smaller government, even though Trump has really not fulfilled that pledge, the markets are going to be concerned about that because it's hard to take a call on a company. I say this because it does help to paint a picture for why we're getting the kind of sell-off that we're getting when we're getting it. Now, again, that's not a single causality. What we also have involved here is we have things like seasonality, just the time of year. Generally speaking, we can look back at the past 10 years and we can see that September is a month. And look, we create the time frames, right? We're measuring the time frames. The market's just going along. The market really doesn't pay much attention to the calendar, but the truth is that the participants in the market do care about the calendar. They're human. But going back 10 years, there's only 3 months that have a average percentage of times when that month closes higher than it opens for the S&P 500. So if you were to take the past 10 years and for each of the 10 years, look at the S&P at the first and the last day of each month, and then you look at the percentage of those months, only 5 of those 10 years has September closed above the point where it had opened on the first of the month. That is the lowest percentage of all the months. And again, that's shared by August and it's also shared by March. So March, August, and September, all 50% higher, higher 50% of the time. So seasonality, that is something that comes to pass. That is something that is interesting. It also begs the question of, are investors concerned about the other side of that coin of seasonality, which is typically November and December, including October to some extent, are rather successful months. They tend to close higher than they open as a month. There may be some concerns about that. There may be some concerns about general spending. There may be some concerns about, the retail sector, about all the different influential factors that come to play at the end of the year. But that's something that we'll have to wait and see. One of the other major factors that's at play right now is coronavirus. I can't ignore the big, fat, pink elephant in the room. There seems to all of a sudden be a renewed interest in case count. We've got this fear-mongering that seems to have come back, but what that's also, interestingly enough, what that's done is it's pushed market interest back into the COVID stock names, the work-from-home types of companies. So that renewed interest seems to have begun lifting the NASDAQ 100 back up, while the rest of the market seems to be in a deeper correction. And then really the kind of crown jewel in sequence of events over the past couple weeks has been the death of Supreme Court Justice Ruth Bader Ginsburg. This should not come as a surprise to people. Her health has been very poor for quite some time. She's been in and out of the hospital quite a bit. So it shouldn't come as a surprise, but the timing of things really is important here, because I think most people had kind of assumed, well, she's been in and out of the hospital. Chances are, though, she's been doing as well as she has, she'll live through at least the election. Then there won't be this question, this uncertainty. But alas, we have uncertainty because there are a lot of rulings that are going to be on the docket in the coming years that will impact publicly traded stocks, that will impact companies. This is interesting to say the least, but it's also just another reason to throw into the mix. So right now, where we are in general markets, we've got the S&P that has sold off quite a bit. Is it a huge decline? No, it's not a huge decline. We're down, we've neared the 10% mark, but we really haven't cleared the 10% mark. So what would be deemed a technical correction, we've not yet fully achieved. We certainly haven't closed below those levels, but we definitely come down and we bounce off of those levels. Well, it's actually kind of interesting because that 10% mark, coincidentally, is the mark that the market tends to go down to and then bounce right off of, and go down to and bounce right off of. So that actually proves to be a fairly good sign in terms of where we are in this corrective process. If it keeps wanting to try to test that and it bounces back up, some would argue that that makes that support less viable. It makes it weaker. It's kind of the idea of every time a hammer hits something, it makes it weaker. Eventually, if it hits it one last time, it doesn't matter how hard, it'll break. In this case, I'm actually of the mind that the market is really wanting to establish a new kind of landing zone, a new landing in the staircase. It has all the reasons to want to break through, but it's not breaking through, which is actually a good thing. But it also means that there's probably an emphasis on the expectations for the Fed and what the Fed is going to do. Are they going to step in again? Are they going to come in and shower everyone with magical fairy dust that everybody then can fly higher and higher and higher? Whether or not that happens is yet to be determined. They've taken a less dovish stance in the past couple weeks, which may have played into the selling also, but they still remain very dovish. And I hate to say it, I don't like this. We have placed a exorbitant amount of power in the hands of unelected officials by way of the Federal Reserve Committee, or the board. But something that should be noted is that currently the Federal Reserve Chair is an appointee of Trump. There is an inherent bias or reason why that particular candidate would want to help bolster Trump's well-being in the political environment. So there may be some policies that are enacted that help stabilize markets through the election period to simply make Trump look good. Because at the end of the day, something that Trump has done, for better or worse, more often for worse, is that he has tied his presidency to the state of the markets. That's a very dangerous game to play. He's not tying his presidency to the state of the future of America, to the well-being of Americans. He's tying it to how well the stock market's doing. That's not a good thing to do. But we can see here on this particular chart, something that is important to note is that we had a very substantial uptrend coming out of that corrective period there in early June. And really, that particular trend had fairly wide bands on it, but it ascended up. And then we ended up finding a breaking point sometime around the 21st or so of September. Doesn't mean that's when the selling began, but that's when we ended up breaking the lower band of the uptrend, putting us into formally a downtrend. Now, a downtrend on the S&P 500 is not necessarily a bad thing. It's okay to sell off. What does become questionable, though, is where is the support? I would argue that we actually have a pretty clear support region that was actually made in those early June days. We ended up getting a pretty good idea of where the upside resistance for the market, in other words, what was the market trying to beat its way up through, but every time it hit it, it bonked its head and fell back down. Well, once it eventually did ascend up through those levels, which didn't happen until, really late July, early August, it ascended up. It came back down into that zone of resistance, but that zone of resistance became a zone of support. That often happens. It's a polarity principle. That's a term that's used for it. Well, that zone of resistance becoming a zone of support has actually coincidentally provided us an outstanding support zone for our current marketplace. So right now I am watching very closely something around 3217 on the S&P. Again, the idea that we keep testing this support region, yet we've not broken down through it. And in fact, as I've been talking, the market has bounced again off of that support region and has moved its way north. That to me is actually quite a reassuring sign. That's giving me some faith that we may actually be towards the end of this particular selling period. Now, the uncertainty will still remain. The questions around Supreme Court will still remain. And again, if we keep bouncing off of this resistance zone, that to me is going to be a reinforcing and very positive consideration, putting us or setting us up for what may actually be a decent end of the year. I don't expect it to be great, but I do expect it to be decent on what I'm seeing right now. I'm willing to change my tune if the evidence changes.